How does VaR measure potential losses in commodities? Imagine you're holding a basket of commodities like oil, gold, or agricultural products. You want to know how much you could lose if the market suddenly turns against you. That's where value at risk, or VaR, comes into play. It's a tool that helps investors and traders understand the worst-case loss they might face over a specific period with a certain level of confidence. Let's break down how it works. First, you choose a confidence level, usually 95% or 99%. This means you're saying, I want to know the maximum loss I might face 95 or 99% of the time. For example, if your one-day VaR at 95% confidence is $50,000, there's a 5% chance you could lose more than that in a single day. Next, you decide on the time horizon. This could be 1 day, 10 days, or even a month. The longer the period, the higher the potential loss because prices can fluctuate more over time. The goal is to match this period with your risk management plans. Finally, VaR estimates the maximum loss in dollar terms that you probably won't exceed during that period, given the confidence level. If your portfolio's one-day 95% VaR is $100,000, it means under normal market conditions, you're unlikely to lose more than that in a single day. To calculate VaR for commodities, traders use different methods. The variance-covariance method assumes commodity prices follow a normal distribution and uses data on past price volatility and how different commodities move together. It's quick but can underestimate risk during extreme events. Historical simulation looks at actual past price changes to see how losses could happen, capturing real market behavior. Monte Carlo simulation creates thousands of possible future price paths based on statistical models, helping to understand complex scenarios and rare events. Why is VaR useful? It gives a clear, comparable number that shows how much you could lose. It helps set limits and decide how much capital to keep aside for potential losses. Regulators often requiring it to ensure firms are managing their risks properly. It also helps in stress testing, showing how extreme market moves could impact your investments. But VaR isn't perfect. It mainly considers normal market conditions and can miss the impact of sudden shocks or extreme events, which happen often in commodity markets due to weather, geopolitical issues, or supply disruptions. It also doesn't tell you how much you could lose beyond that threshold, known as tail risk. Plus, its accuracy depends heavily on the quality of data and assumptions used in the calculations. In practice, investors combine VaR with other risk tools and analysis to get a full picture. They might use it to decide when to hedge or diversify their positions. Overall, VaR is a valuable part of a risk management plan, helping protect capital by giving a realistic view of potential losses in commodity markets.